everyone. In the last chapter, or you can say in the last lecture, I have talked to you about with the cost of capital. And I have given you the introduction, that means on which factors we are going to decide that from where we have to arrange the money, from whatever sources we have to arrange the money, and on which our cost of capital will be dependent. In the last video, I have also talked about the components of our cost of capital. So first, one of the component of the cost of capital is cost of debentures. That means we are going to borrow the money by way of debt. And whenever we talk about debt, debt means your debentures, your bonds and your loans. So today in this lecture, I'll be discussing about the cost of debentures, or you can treat it as your cost of bonds, or you can treat it as your cost of loan. So debentures is a type of debt instrument that is unsecured by collateral. So that means it is one of the kind of debt instrument. I have also discussed the difference between what do you mean by debt, or you can say what do you mean by debentures. What are the preference shares and what are the equity shares? For that you can go to the previous lectures and you can just have a knowledge about what is the difference between these three types of. So moving further, if I'll talk about debentures are divided into two parts. First is redeemable and the second is irredeemable debentures. Now when we talk about the features of debenture, so one of the feature that we have to remember throughout the working of the debentures is that there is a fixed rate of interest. That means whenever you purchase the debenture or company issues a debenture, there is a coupon rate over there, which means that company will give you the fixed rate of interest. If let's say your face value of one debenture is ₹100 and the coupon rate is 10%, so every year company will pay you 10 rupees as a interest. So which means fixed rate of interest, and this fixed rate of interest will be irrespective of the profit that the company is earning. But over here you have to remember that fixed rate of interest is always calculated on the face value. It will never be calculated on your sale value. That means on whatever the price the company is issuing the debentures, it will not be calculated on that. It will always be calculated on the face value of a debenture. Second is net proceeds from the issue. Now net proceeds from the issue means whenever you are issuing the debentures, so whatever net amount the company is receiving, or you can say what net funding company is getting by issuing the debentures. For example, if I say that I have to issue the debenture, I am a company. So the one thing is that no one is aware about my debentures. That means no one is aware that I am going to issue the debentures. So for that, what I have to do, I have to give the advertisement, or I have to keep one book builder. Now what is book builder? I have also discussed in my previous videos. Book builder is just like a agent who is going to help you in selling your debentures. So whenever you are arranging the book builder, he will charge some commission or fees. So if you are giving advertisement, you have to pay some charges. If you are going to get your debenture registered in stock exchange, so again you have to pay some fees. So that means whenever we go for the debentures, whenever we issue debentures, we are incurring some expenditure for the issue of debentures. So net proceeds means whatever amount I am getting by issue of debenture, from that amount I have to subtract all my expenditure. Let's say I'll take you just for a small example. Let's say the face value of one share is, or your one debenture is ₹100, right? Now I spend, let's say for the book builder is saying I'll charge 1% commission for issue of one debenture. That means if the book builder is helping me to get the amount issued, to get the debentures issued and arranging the money for my business, so he's saying that I'll be charging 1% commission. So if I am getting 100 rupees by sale of one debenture, I have to pay 1 rupee to the book builder, to the commission agent, to the person, to the broker. I have to pay 1 rupee. So it means the net proceeds that I am getting from sale of debenture is 99 rupees. So net proceeds from the issue is 99. Or if I'll say I issue the debenture on premium and premium amount is 10 rupees. So my face value of debenture is 100. I issue the debenture at 10 rupees premium. So total amount is 110. And the broker says that I'll charge 2 rupees as a commission. So I have to pay him 2 rupees. So that means net proceed will be 108. So net proceeds means whatever amount you are getting by issuing your debenture, you have to subtract your floating cost. And floating cost means all those expenditure that is being incurred at the time of issue of debentures. Now third is date of maturity and the premium amount to be paid at the time of their maturity. Now date of maturity means whenever we are issuing debentures, I told you that there are two types of debentures, redeemable and irredeemable. So suppose we have to pay the amount at the end of 10 years. I have issued the debenture only for 10 years. At the end of 10 years, I have to pay back the amount. So that will be your date of maturity. That means till that date, I got the amount. And on the maturity, I have to pay the amount borrowed plus some extra amount. Whenever you are redeeming the debentures, whenever you are paying back the amount, it can be at par, it can be at premium. So if it is at premium, you have to pay some extra amount, and that is known as premium amount that is to be paid at the time of maturity. And the next is income tax rate. As we have already discussed in the previous lecture, that means if the government is charging some income tax, that means government is charging some corporate tax, we get the tax levy, or you can say tax shield whenever we are issuing debentures. So income tax rate also play a major role in deciding the cost of debentures. Now let's talk about what do you mean by redeemable debentures and what is irredeemable debenture. Now if I talk about irredeemable debentures is perpetual of debt, or you can say it's perpetual in nature. That means whatever the borrowers need not to repay it to the lenders. That means we never have to repay the principal amount to the lender. If I am a company, I am issuing the irredeemable debentures, and let's say I issue the irredeemable debentures to the investor, and investor pay me for rupees 100. Investor pay me rupees 100, and the coupon rate is 10%. So I have to pay 10% interest every year, but I will never repay his amount of rupees 100 that he paid me at the time of issue. So that means borrower need not to repay it to the lender. However, interest payments are regular on irredeemable debt. I have to pay the interest, and the interest over here, it says that interest payment is regular. Regular means after each equal interval of time, I have to pay the amount. Now, if you will see this time graph, I have shown you that this is 0. As we have already discussed, 0 means your current value. And 1 means at the end of period 1. 2 means at the end of period 2. And 3 means at the end of period 3. So over here, since we are talking about debentures and we have to pay interest annually, so in this timeline, this 1 represents at the end of year 1, at the end of year 2, at the end of year 3, and so on. And if you will observe, I have written infinity over here because this is irredeemable. We never have to pay the amount back to the investor, but I have to pay the interest throughout the life. So that means at the time 0, that means current time period, I have borrowed the amount, and these are the time period where I am paying the interest, and I am going to pay the interest till infinity because I am not aware about till when my company will last. So throughout the life, I am going to pay the amount. And if you will see this number line, this is forming a part of perpetuity. And we have already discussed what do you mean by perpetuity. Perpetuity means that there will be a regular cash outflow or inflow. So in this you can see that there is a regular cash flow. After every equal interval of time, we are paying the interest to the investors. And I am not aware till when I have to pay the interest. So this is forming a perpetuity. So irredeemable debentures, we have already discussed, it is a part of perpetuity. And if we talk about irredeemable debentures, these are again divided under two parts. One is with tax and one is without tax. So that means we are going to cover both the parts. When the government is charging tax, that means when the corporate tax is there on the company and when the corporate tax is not there. So if we will see the corporate tax, the formula for your perpetuity, we have already done that the present value will be equals to future value divided by R. So now you will see I have written 0. So that means present value always stand for the current year, and in this the future value will be your 1. Because in the last number line I have shown you that whenever we are calculating the today's value, whenever I am borrowing the amount from the immediate next year, I am going to pay the interest. So what I have done in case of irredeemable debentures, I have done nothing. Instead of present value, that means I am not talking about present value, I have replaced this PVA with the form of NI. And instead of future value, because in the future I am going to pay interest, so I have written I. And over here rate of interest I have replaced with KD, and KD means cost of debentures. So NI, as we have already discussed, that NI means net proceeds from the sale of debentures, or you can say issue of debentures. So it can be a face value. FV stand for face value. And if the debenture is issued at premium, you have to add premium in the face value. And if your debenture is issued at discount, you have to subtract the discount amount from the face value. And whatever be the answer, you have to subtract your floating cost. That means whatever cost is being incurred, whatever expenses are being incurred while at the time of issue of debentures. Maybe your commission, maybe your book building cost, maybe your advertisement cost, maybe any cost. And I means interest, which is paid every year, and this is the fixed interest. And KD means cost of debentures. Now if we will see this equation, your present value is nothing but the summation of all the future values. So whatever future value I am giving at the end of year 1, at the end of year 2, at the end of year 3, and so on till infinity. So this is the summation of all the future values. We can also say that the present value, whatever amount I have borrowed today, that means, or whatever amount I have received at the time of issue of debentures, it is just a summation of all the future values. Once I'll convert all the future values into present value, the amount will be same. Now if we talk about the cost of irredeemable debentures, with the amount of tax, the only thing is that whenever we are talking about tax, we are getting the tax shield. So if 50% tax rate is there, we are getting 50% tax shield. So we have to do nothing. But what we are going to do, instead of I'll write I1 minus T, and where T will be your tax rate. NI will be same, interest rate is same, KD is same. The only thing is small t, which is known as tax rate. So tax shield will be there. So what we have to do, we just have to multiply it 1 minus T. If 50% tax rate is there, we are getting 50% tax shield. 40% tax rate is there, we are getting 40% tax shield. It means on remaining 60%, that will be my consider for the KD. Now redeemable debentures. Now redeemable debt is a debt that is repayable back to the lender by the borrower within a specified period of time. Now that means if I am borrowing the money at a fixed period of time, I am getting the money, I am issuing the debentures for a fixed period of time. In the previous case, what we have seen, irredeemable means we are never going to repay the money, and you have to pay the interest till infinity. Your time period is not known. But over here, time period is known. Now if you will see again the same timeline, in this you can see that we are paying the interest till a particular period of time. In this timeline I have taken, suppose I have giving the interest till 15 years. That means I have issued the debentures for 15 years. Maturity period is 15 years. So specific time period is given over here. Now if you can see, the specific time period is given. This is my specific time period, and I am going to pay the amount till 15 years. And at the end of 15 years, I am paying interest every year till 15, and at the end of 15 years I am giving the maturity value also. So this will be your amount borrowed, and till this time period you have to pay interest till 15 years plus redeemable amount you have to pay at the end of 15th year. So this is forming a part of annuity. Because the only difference between annuity and perpetuity is that in perpetuity, I'm not aware about the last date. I'm not aware about the time period till when I have to pay. But in case of annuity, I am aware that this is the last installment that I have to pay. Over here, I am aware that till 15 years I have to pay the interest, and at the end of 15 years I have to pay the maturity value also. And regular cash flows are there. Every year I have to pay the interest irrespective of the profit. So that means this is forming a part of annuity. Now, redeemable debentures, whenever we are going to calculate the cost of debt, redeemable debentures are divided into two parts. One is whenever we are paying the maturity value in lump sum. That can be with tax, that can be without tax. And the second is whenever we are paying the maturity value in installment, and again that can be with tax and without tax also. Now first of all, let's see whenever we are paying the debentures in lump sum. Now as we have already discussed that this will be our equation, what we have to do, we have to convert each future cash flows into the present value. So what I am doing, I am just converting the future cash flows into the present value. So it will be FV1 divided by 1 plus r raised to power 1 FV2, whatever amount I am giving at the end of year 2, upon 1 plus r raised to power 2 till my nth time period. In our example, my nth time period is 15, so over here you will write the 15. So what we are doing, we are writing the value of debenture at the time 0, that means current year, and it will be interest paid 1 plus kd, 1 upon 1 plus kd raised to power 2 till n, and at the end year I am also writing the maturity value. So this is the kd that we have to find out. This is known as your cost of debt. And now moving further, whenever we are talking about redeemable debentures in lump sum, we are giving the amount in one shot only. So that method is divided into two parts. The first is your present value method and second is your approximation method. So let's see what do you mean by present value and what do you mean by approximation method. Under approximation method, we will be using the help of formula. We are taking the help of formula. So your formula will be cost of debt will be equals to interest 1 minus t, and if you are doing without tax, so instead of t you can write 0. So interest paid 1 minus t plus redeemable value minus sale value upon n, and divided by RV plus SV divided by 2, where your interest will be annual interest paid, your T will be company's effective tax rate, redeemable RV means redemption value, that means whatever amount you are paying at the time of maturity, your N will be number of years of maturity, and SV means issue price per debenture plus premium minus floating cost and discount. That means whatever, if you are selling your debentures at premium, you have to add it. If you are selling your debentures at discount, subtract the discount, and you have to subtract the floating cost. So if we are doing by present value method, so again the same thing we have taken. We have taken interest 1 minus t because the debentures are always getting the tax shield. If the company is not charging any tax, that means government is not charging any tax, instead of t you can write 0. So again the same thing, every whatever the future cash flows I am giving, I am converting into the present value. So I1 upon 1 plus kd raised to power 1 till your nth period. So if you are going to sum up, this will be your equation, where again same I is interest paid, T is corporate tax, KD will be cost of debt, your RN will be redeemable value at the time of maturity, N is your number of years. So this is what we are going to do. So this is just an introduction about the cost of debentures, how we are going to do it. For further reference, you can refer my book, Financial Management. Thank you.